When you deposit money into your account, the bank doesn't just hold it, they flip it, stretch it, and multiply it. And you don't see a dime. In this video, we're pulling back the curtain on what banks really do with your money. You might think your money just sits there, gathering a tiny bit of interest, but the reality is far more complex, and frankly, a little bit mind-blowing. We'll explain the key ways banks put your deposits to work, some of which you've probably seen without even realizing it. The difference between feeling in control of your finances and feeling like a passenger is understanding this one thing. First, let's address the most obvious point: lending. When you deposit money, it doesn't just stay in a vault. Banks use a significant portion of it to provide loans to other customers: mortgages, car loans, personal loans, and business loans. This is how they make a large chunk of their profit through interest. Think of it like this: your $10,000 deposit doesn't sit idle. A bank takes a slice of that, combines it with millions of other people's slices, and uses it to fund a family's new home, or help a small business owner buy equipment. You've probably seen these loans advertised everywhere, but you never stop to think that it's your money, your collective money, that's making it all possible. But here's where it gets wild. It's not a simple one-to-one relationship. Banks operate on something called a fractional reserve system. This means they're only required to keep a small percentage of your deposits on hand at any given time. The rest? It's out there being lent and multiplied in the economy. It's the closest thing we have to a money-making machine. If you care about understanding how the financial system truly works, hit subscribe. What's coming next might just change how you view your bank account forever. Now you might be thinking, okay, they lend money. That makes sense. But what else do they do? This is where the story of a local bakery comes in. The owner, a woman named Maria, started her business with a small loan from her bank. Every day she deposits her cash earnings. That money, along with everyone else's, gets pooled. Banks then use these vast pools of capital for other activities, like investing. Yes, banks are major players in the investment world. They invest in a wide range of assets, from government bonds to stocks, and even more complex financial instruments. This is a huge way they generate revenue. You've probably seen news headlines about massive bank profits. A big part of that comes from these sophisticated investment activities. They're not just passively holding your money, they're actively trying to grow it for themselves. We'll explain more on how these investments impact the economy later in the video. Now let's talk about fees. Banks generate substantial income through various fees: overdraft fees, service charges, ATM fees, and more. You've probably experienced these firsthand, maybe with a little groan. These fees, while sometimes seemingly small, add up to billions of dollars in revenue for banks annually. It's like they're charging you a tiny toll for the convenience of holding your own money. For example, that $35 overdraft fee you got last year, that single fee multiplied by millions of people becomes a serious revenue stream. It's a key part of their business model, and many of these fees hit you when you're already in a tough spot. But here's where it gets more interesting. These fees often disproportionately affect lower-income individuals. It's a loophole in the system, where those who can least afford it sometimes end up paying the most. The same bank that gave Maria her business loan is also charging her a monthly service fee. It feels like a small thing, but for her, every dollar counts. This is a subtle but powerful way the system maintains the status quo. You might be wondering, is my money safe then? Regulations and insurance mechanisms like the FDIC exist to protect your deposits up to a certain amount. This was a crucial development after past financial crises to maintain public trust. So, while your money is actively being used, there are safeguards in place. It's not about your individual dollars disappearing. It's about what the banks are allowed to do with the collective pool of everyone's money. Beyond lending and investing, banks also provide a multitude of services: payment processing, wire transfers, safe deposit boxes, and financial advisory services. Each of these generates further income. Think about how often you use your debit card. Every transaction involves a small fee that the bank processes. Remember Maria from the bakery? She's not just depositing money, she's paying a fee for every credit card transaction her customers make. It's a complete ecosystem designed to generate revenue at every touch point. Coming up, we're going to share how banks use sophisticated algorithms to predict our spending habits, and it's both impressive and a little bit creepy. Now, let's circle back to those investments we mentioned. Banks don't just randomly throw money at stocks. They have sophisticated teams of analysts and use complex models to make investment decisions. These decisions can have a significant impact on the broader economy. When banks invest heavily in certain sectors like tech or real estate, it can fuel growth. But conversely, risky investments can contribute to financial instability. Think back to the 2008 financial crisis. Banks were making huge bets on complex mortgage-backed securities, and when those bets went sour, the entire economy almost collapsed. Your savings account was not directly at risk, but the entire system it was a part of was. You've probably seen news reports about the health of the banking sector influencing the stock market. This is why. Here's another layer. Banks also play a crucial role in creating money through the process of lending. When a bank approves a loan, they're not simply handing over existing deposits. They're essentially creating new money within the system, based on those fractional reserves we talked about earlier. It's a bit of a mind-bending concept, but it's a fundamental aspect of modern banking. For example, if you take out a $300,000 mortgage, the bank doesn't just pull that money from someone else's savings. They literally create it on their balance sheet. This new money then circulates through the economy when you pay for your new house. It's a fascinating, almost magical process. Later, we'll share a little-known secret about how banks influence interest rates for everyone, even if you don't have a loan with them. So, to recap, banks primarily use your money for lending, investing, and funding various services, all while generating revenue through interest and fees. The fractional reserve system allows them to lend out more money than they actually hold in deposits. And their investment activities play a significant role in the economy. The story of Maria's Bakery highlights how everyday businesses and individuals contribute to this massive flow of capital that banks manage and leverage. Their deposits, combined with everyone else's, power the loans and investments that shape our economic landscape. The fees they pay, while perhaps frustrating, are also a part of the bank's operational model. This is all to say that your relationship with a bank is more than just a place to keep your money safe. It's a dynamic, intricate relationship where your funds are a key component of a multi-trillion-dollar system. Understanding this doesn't mean you shouldn't use a bank. It means you should be an informed, savvy participant in the game. It's about recognizing the subtle power dynamics at play. If you thought this was helpful, wait until you see what happens in the next video.